You have been in this situation before. The market is doing nothing. Candles overlapping, no direction, no momentum, nothing setting up. You switch time frames looking for movement, you find none. You start questioning whether you are even reading the right chart, so you wait, and then a candle breaks. Strong, aggressive, convincing. The direction is suddenly obvious. Your convictions builds. You enter and the market reverses directly against you. Then, after the reversal traps you, the real move begins in the direction you originally thought without you. That sequence did not happen to you randomly. That sequence was built for you. Every phase of what you just experienced, the boredom, the convincing breakout, the trap, the real move, was a deliberate institutional campaign designed to produce exactly the emotional response you had at exactly the right moment for them. That is what this video is about. By the end of this video, you will understand why the market moves through three distinct phases before almost every real directional move, why the boring range that makes you want to stop watching is actually the most important phase of the entire campaign, why the convincing breakout that triggers your entry is specifically designed to feel convincing, and why the real move, the one you wanted to be in, begins precisely after your emotional commitment is fully extracted. This is not theory. This is the sequence playing out on your chart right now. In every session, on every time frame, in every market you trade. Stay with me. I am Bilal, the disciplined trader. This is episode 6 of the Operator SMC series. Every episode in this series is built on one discipline. Understand the mechanism before you learn the pattern. Because a pattern without a mechanism is just a shape you recognize too late. Let's get into it. Here is what most traders experience without ever understanding why. They sit through a range, price moving sideways, no clear direction, the chart feels dead. Their patience deteriorates candle by candle. They start forcing analysis, drawing slave wheels, projecting breakouts, switching timeframes looking for something that confirms what they want to see. Eventually they give up on direction entirely, or worse, they start trading the range edges randomly just to feel productive. Then the breakout comes, and it does not come quietly. It comes with aggression. A large candle closes beyond the obvious level, volume increases, momentum builds, social sentiment flips instantly. Every trader watching that chart sees the same thing simultaneously and reaches the same conclusion. The move is real, the direction is confirmed. This is the entry. So they enter. Breakout traders go long. Short sellers panic and cover. Momentum chasers pile in. Emotional certainty reaches its peak. And then, within minutes or hours, price voluntarily reverses. The breakout fails, the traders who entered are now trapped. Their stops trigger, their force exist accelerate the move in the opposite direction. And then, from the wreckage of that trap, the real expansion begins. Clean, efficient, sustained, in the direction that the chart was always going to move. By the time that real move becomes emotionally obvious, the traders who were trapped are already out. The traders who were watching from the sidelines are now chasing. And the institutions that engineered every phase of that sequence from the beginning are already delivering price towards their objective. This is not bad luck. This is not a random market being unpredictable. This is a campaign and you were a participant in it without ever knowing your role. Here is what almost every trader believes about how markets move. They believe the market moves through phases randomly, that accumulation happens when smart money decide to buy. That manipulation is smart money hunting. It stops for sport. That expansion is simply the trend continuing after the range resolve. That understanding is so incomplete it becomes dangerous because it makes the trader a passive observer trying to label phases after they complete, identifying accumulation in hindsight, recognizing manipulation after they were already trapped, entering expansion after the move already displaced. This is not edge, that is a description of losses. Here is the contradiction that changes everything. Traders believe the markets move through phases. Operators understand the market moves through your emotions. Every phase of AMD is engineered to produce a specific psychological state in retail traders. Not because institutions are malicious, because your emotional state at each phase determines whether you provide provide the liquidity they need to execute efficiently. During accumulation, your boredom and impatience are the mechanism. They are what prevent you from positioning early. During manipulation, your certainty and urgency are the mechanism. They are what make you commit capital at exactly the wrong movement. During expansion, your relief and FOMO are the mechanism. They are what make you chase a move that no longer needs your participation. The market does not just move through phases, it moves through your emotions. And every phase is designed to make you feel exactly the wrong thing at exactly the wrong movement for you and exactly the right movement for the campaign. In a moment, I'm going to walk you through each phase in detail, not as a diagram, not as a labeling system, but as a lived psychological experience. What you feel during each phase, what that feeling is actually doing to your decision making, and what an operator observes while you are reacting. Because once you understand what each phase is designed to make you feel, you stop being a participant in the engineering and you start being an observer of it. The first phase is accumulation, and the most important thing to understand about accumulation is this: it is specifically designed to feel like nothing, not because nothing is happening, because the most important thing that can happen in a campaign needs to happen without your attention. Institution cannot enter large positions the way retail traders enter. A retail trader clicks buy and the position fills instantly. An institution attempting to build a significant position does the same thing and price moves against them before they are halfway filled. Their own buying worsens their entry. Their intent becomes visible. Other participants front run them, so they cannot simply enter. They must absorb gradually, quietly, over time, accepting the sell orders that come to market without allowing price to move aggressively upward, controlling the auction, minimizing their footprint. This is what the boring range actually is. Not directionless price, not a dead market, not a chart worth switching away from. Hidden inventory transfer beneath control conditions. Now, here is what you feel during accumulation and why that feeling is the mechanism. The market is going now here. Candles overlap, volatility contracts, nothing confirms. Your dopamine system, trained by every previous exciting trade, start demanding stimulation. You feel restless. You switch time frames. You look for momentum elsewhere. Your patience deteriorates not over hours but over minutes. And the most common decision retail traders make during accumulation is to stop watching. They mentally disengage from the exact phase where the campaign is being built, or worse, they start trading the range edges, selling at the top of compression, buying at the bottom, accumulating small losses while institutions accumulate large positions. Here is how you identify accumulation behaviorally. Not in hindsight, but while it is forming. Watch for failed continuation. Price pushes lower aggressively and then stops. The bearish candles lose efficiency. Follow through weakens. The move that looked like breakdown simply dissolve back into range. Sellers are trying, but something is absorbing their patience without allowing continuation. That absorption is the behavioral signature, not the sideways price. The failure of one side to extend. Watch for compression quality. Real accumulation feels controlled, like pressure being held in place. A dead market feels empty, random, no defense, no absorption, just thin, directionless rotation. The difference between them is felt more than seen. Real accumulation has weight to it, suppressed energy rather than absent energy. And watch your own emotional state. If you are bored, impatient, and questioning whether anything is setting up, that emotional environment is exactly what accumulation is designed to create. Your discomfort is not a signal to leave, it is information that the campaign may be building. The second phase is manipulation, and everything that made accumulation feel invisible, manipulation makes feel undeniable. After accumulation has transferred sufficient inventory, the market needs something specific before it can expand efficiently. It needs committed participants on the wrong side. It needs trapped traders whose force exist will fuel the real move. It needs emotional certainty concentrated in the wrong direction. Manipulation exists to manufacture that certainty. Here is the engineering logic. During accumulation, traders have been watching a range. They have been conditioning themselves to expect a breakout. Pressure has been building psychologically for hours. Their expectation is primed. Then price breaks the obvious level, aggressively, with commitment, with the kind of displacement that feels institutional. And your nervous system responds exactly as designed. Adrenaline, urgency, the sudden clarity that the move you were waiting for has finally arrived. FOMO activation before your analysis is complete. The emotional certainty that this is real, arriving faster than any rational evaluation could. Breakout traders enter, short sellers cover in panic, momentum chaser pile on, social sentiment flips from neutral to unanimous in minutes, and that unanimity, that emotional consensus is exactly what manipulation needed. Because concentrated emotional commitment creates concentrated liquidity, and concentrated liquidity is what institutions need to execute the real move efficiently. Here is how identify manipulation behaviorally while it is forming. Watch acceptance, not movement. Price broke the level, that is movement. The question is whether price is holding beyond the level, whether candles are building value there, whether pullbacks are defending the new pricing. Manipulation moves aggressively, but it does not accept. It spikes through a level and then hesitates, rejects, returns back toward where it came from. The aggression was real, the acceptance never arrived. Watch the emotional quality of the move. Real institutional displacement feels efficient, purposeful, like the market is going somewhere with commitment. Manipulation often feels emotionally theatrical, urgent in a way that bypasses analysis. The move creates a feeling that thinking about it means missing it. That urgency, that bypass of analysis is itself the signal. And watch what the move creates. The most important question during manipulation is not whether price moved, it is what behavior that movement produced. How many traders just committed capital in this direction? How many stops just triggered? What emotional positioning just concentrated on the wrong side? Because that trap participation becomes the fuel for what comes next. In part 2 of this series, we are going to cover expansion, the real move, and exactly how to identify which phase is active before it completes. The 4 behavioral clues that single transition and the operator framework for reading AMD in real time instead of in hindsight. But before we get there, I want to show you the complete sequence visually, because understanding each phase intellectually and seeing the entire campaign as one living sequence are two completely different things. Picture this on a chart. Price has been ranking for several hours. Candles overlapping, no direction. The obvious resistance level sits clearly above. Every trader watching this market can see it. They have been watching it for hours. Their expectation is built around it. During this compression, sellers repeatedly push lower. Each push loses efficiency. Follow through weakens. The downside continuation that should be accelerating simply dissolves. But retail is not watching the failed continuation. They are watching the absence of upside movement and concluding nothing is happening. Then the breakout candle appears. Large, bullish, closing above the obvious, resistance with aggression, volume spikes, the social feeds lights up. Breakout traders enter immediately. Short sellers begin covering. The move feels undeniable. And then, one candle later, rejection begins. Price cannot hold above the level. They follow through that should confirm. The breakout never arrived. A sharp bearish candle forms, then another. The breakout traders who entered aggressively are now underwater. Their stops sit just below the level they entered at, and price is heading directly toward them. The stops trigger, the forced exit accelerate, the downside move. The short sellers who covered in panic are now trapped long. Their liquidations add more fuel, and then, from the middle of that chaos, a single displacement candle forms to the downside. Clean, efficient, urgent, in a completely different way from the manipulation spike above. This move does not hesitate at the level, it accepts below it. Pullbacks forms and hold, continuation persists. The real move has begun. Every participant who provided liquidity during that sequence, the breakout traders, the panic covers, the momentum chasers, they are now the fuel the real expansion is feeding on. The campaign that started in the quiet of accumulation, the failed downside continuation nobody was watching, delivered its objective through the emotional commitment of every trader who reacted to the manipulation. Not random, not unpredictable, engineered. The market does not just move through phases, it moves through your emotions. Every phase is designed to make you feel exactly the wrong thing at exactly the wrong movement. Accumulation is designed to make you feel like nothing is happening, so you disengage from the phases where the campaign is being built. Manipulation is designed to feel like everything is happening. So you commit capital at the exact moment your commitment becomes someone else's liquidity. Expansion is designed to feel obvious. So you chase a move that no longer needs your participation. And the most dangerous part of this entire sequence is that every emotional response it produces in you feels completely rational in the movement. The boredom during accumulation makes sense. Nothing was moving. The certainty during manipulations makes sense. The candle was aggressive. The urgency during expansion makes sense. The trend is finally clear. But rational, emotional responses to engineered conditions are still engineered responses. The transition from reactive trader to operator does not happen when you learn to identify AMD on a chart. It happens when you recognize your own emotional state as part of the data. When you sit through a compression and notice the boredom rising, and instead of switching charts, you ask, what continuation is failing here? Who is absorbing this pressure? Is this a dead market or a controlled one? When a breakout candle appears and instead of feeling certainty, you feel a different question forming, is this being accepted or just spiked? What did this move create emotionally in the crowd? Who is now trapped? When expansion finally begins and instead of chasing you observe, is this being defended? Is participation sustaining? Is this the campaign delivering or the campaign exhausting? Your emotional state stop being a reaction to the market. It becomes a source of information about it. Because if you are feeling urgency, the market may be engineering urgency. If you are feeling boredom, the market may be engineering disengagement. If you are feeling certainty, the market may be engineering consensus. That is not a mindset shift, that is a perceptual one. And the difference between those two things determines everything that follows. 3 mistakes that prevent this from being stalled. Mistake 1. Abandoning accumulation before it completes. The boredom during accumulation is not incidental to the phase, it is the phase. Accumulation is specifically designed to feel like nothing is happening because the most important transfer of inventory requires your inattention to occur efficiently. The move the chart feels dead and you switch time frames, switch markets or begin randomly trading range edges. You have responded exactly as designed. The operator who stays, who watches failed continuation, who observes absorption underneath surface level compression, is watching the campaign being built while everyone else has already left the chart. Mistake 2. Entering manipulation as if it is the real move. The manipulation candle is designed to feel undeniable, large, urgent, the kind of displacement that bypasses analysis and creates the sensation that thinking means missing. Every technical filter the trader has built fires simultaneously, and that unanimous internal signal, that feeling of complete certainty, is the manipulation achieving its purpose. Traders who understand MD intellectually still enter on manipulation because understanding a trap does not automatically disarm it. The certainty feels identical whether the move is engineered or real. The question that separates the operator is never, does this feel real? It is this being accepted? Is price holding beyond the level or spiking through it and retreating? Certainty is never the filter. Acceptance is. Mistake 3. Labeling AMD in hindsight and calling it understanding. After learning this model, most traders go back through historical charts and labels every phase with complete accuracy, accumulation here, manipulation there, expansion they missed entirely. They do it on 10 chart. They feel like they understand the market. Then the next session opens and they are trapped in a manipulation sequence they literally studied the night before. Hindsight labeling is pattern matching. It confirms recognition, not installation. The ability to name a phase after it completes tell you nothing about your ability to read what is changing while you are inside it. AMD installed means your emotional state during each phase becomes information, not reaction. Boredom during compression becomes a data point. Certainty during a breakout becomes a warning. That shift does not come from labeling history. It comes from observing live markets with a different question. Here is what I want you to do before the next session. Open your chart from this week. Find one range, one period of sideways compression that you either ignored, trapped poorly, or abandoned before the move developed. Now ask 3 questions about it. During the compression, what accumulation was filling? Was one side repeatedly attempting to extend and losing efficiency? Was there absorption underneath the surface that you were not watching because the chart felt dead? During the breakout or spike, did price accept beyond the level or just spike through it? What emotional response did that move create in the market? How many traders committed in the wrong direction at that exact movement? After the real move began, where did I start relative to the trapped participants? Where did the fuel come from? You are not looking for perfect answers. You are training a different question. Not what happened, why the campaign needed it to happen exactly that way. In part 2, we cover expansion, phase transitions, and the 4 behavioral clues that tell you which phase is active before it completes. But before that, accumulation is not a boring range. It is hidden inventory transfer beneath controlled conditions. Manipulation is not a stop hunt. It is engineered participation required for efficient expansion. And the move you keep missing is the move that was built while you were feeling exactly what you were supposed to feel. If this is the work you are doing, stay on this channel.